Perfect. So welcome, guys. Week 4 of the 8-week challenge. We're speaking about home loans, home deposits, and debt repayment strategies today. We've got a special guest, which is exciting. We've got Ross from C-Ross Finance Group. He's joining us. A little bit about Ross before I introduce him. He's got over 6 years in finance, has seen the good, the bad, the ugly of all things to do with home loans. He understands what it takes to repay a mortgage, as he's witnessed it hundreds of times with his clients over the years. And he understands what to look for with a mortgage as well. So when you're reviewing your mortgage or looking at to get updated, it's not all about the interest rate, but Ross will go through all the tips and tricks. So Ross, welcome.
Thanks for having me. Can you hear me okay?
Perfect, loud and clear.
Okay, great. Yeah. So basically there's obviously 3 things that usually you should be looking for when you've got your mortgage. Firstly, I get clients to always look at, does my interest rate start with a 1 or a 2, especially at the moment, where RBA rates are so low. If you've got a 3 in front of your mortgage, you're paying too much. But that's not to say that that's not the right product for you. It just depends on what your loan to value ratios are as well. So just to explain briefly what a loan to value ratio is, it's the amount of money you owe on your mortgage versus how much the property is worth. So if your property is worth 500,000, you've got a mortgage of you've got the example there. There you go. Yeah, it's already thought of all that. Yep. So that it all depends on your rates there, based on your LVR, loan to value ratio.
So what do you mean by that, Ross? If they've got higher than 80%, do I pay more?
You generally, if your rates are higher than 80%, you're paying a lot more than what you would if it was under 80%. This is just obviously because of the risk that the banks take on you. So obviously, the higher the risk to the bank, the more they're going to charge you, basically. So they're going to make you pay a premium for it. But that's not to say that you won't get something under the 3%. There is some lenders out there that are doing it, especially for new clients. And then if you've got your current bank, you can always go back to the bank and just threaten to leave, and they'll lower your mortgage. That's what I did. So, but yeah, obviously, always happy to have a look at it as well. Fixed rates are generally lower at the moment. I've seen fixed rates over 90% have got a 1 in front of them.
Wow.
Especially for first-time buyers as well, just to try and get them locked in, they're gonna see what the best that they can do.
So, what type of term are people generally locking in that you're seeing from your side?
That I'm seeing at the moment, I've seen a lot of people locking in for 4 years just because they are so low, like 1.89, 1.9.
Yeah, right.
1.94, seen some really good ones. But generally, most people do 2 years because you don't know what's going to happen over that period of fixed rate. If you have to sell, then you have break costs. Right? So we can talk more about that later.
Yeah.
Break costs can be pretty. I've seen a break cost $25,000.
Yeah, wow.
Someone to leave, and it's more than worth it for them. So,
yeah.
Or it's all dependent on the situation, really. But another thing to look at is this product right for me? So you may have gone onto a loan years ago with a product that was suitable at the time, but now you look at it and say, well, I don't need an offset anymore. I'm not holding my cash in another account. Maybe I just need to go onto a basic product. So most banks will charge a switch fee. You're switching from a professional package to a basic, but if you look at it in the long term, you'll actually save more because you're not paying all those annual fees. Most banks have annual fees between $250 and $400. The majority I see are around the $400, not $395. Most of the major lenders.
Yeah.
If you're going onto a basic, they don't charge you any fees at all. So it might cost you $500 to switch over to a basic, but you're going to save more than that in the life of the loan. So it might be a nice option for you. But that's all things that we look into as well. And then another thing would be, okay, I've been paying my loan for this amount of time. How much equity do I have? You might be looking at growing your portfolio and buying yourself an investment property. That's something we look at as well.
Just want to speak into the microphone a little bit more.
Sorry.
Yeah, perfect.
That's something we look at as well. Sorry about that. How much equity do I have? What's my LVR currently? Can I pull some cash out of the house and potentially buy another property? I have a lot of clients do that as well. I've got an example, repaying the mortgage of a client that when it comes to repaying your mortgage quicker. So from what I've seen, especially if you're a couple paying a mortgage and if you're both working, I had a couple that basically I did the loan for them about 5 years ago, and they came back to me mid last year, and they had pretty much their whole house almost paid off. And I said, "How did you do that?" They basically one of their pays went straight onto the mortgage. So they obviously lived tight for a few years, but it worked out in the long run because they came back, pulled the equity out, and went and bought another property.
So effectively, they were living off one paycheck, and they were putting the other paycheck towards the mortgage.
That's correct. Yeah. So you can even do things like I saw on her, she salary sacrificed directly into the mortgage rather than buying a car. It depends. I don't think all employers do that. She was in health, and they let her do that, but you could just essentially put one whole mortgage, one whole pay onto the mortgage and bring it down. I've got some examples of paying extra, which I'll go through in a second. But that's something to keep in mind as well, just to try and get it down as quick as possible and build that equity from the start. Another thing you could do for paying quicker is if you are the type of person that holds a bit of savings, rather than having your savings in an ING or a RAMS account earning 1 or 2%.
Not much at the moment.
Not much at the moment. You could be better off having it into an offset account. How an offset account works, so it's just basically an everyday account. What happens is, say you've got
like a bank account?
It's just a bank account. It's an everyday account. You spend out of there, you get your pay going into there as well. Basically, the more you have in offset, the less interest you pay on the loan. So if you've got a $500,000 loan and $100,000 in your offset, you're only paying interest on $400,000. Even though your balance still says 500, you're only paying interest on the 400 because that 100,000 on your offset is basically offsetting the interest on the loan. So for a loan of 500 with 100 in offset, you save about 5 years on your loan.
5 years. Wow.
You pay your loan off in 25 years. I think so you'd save 115,000 in interest
over the term of the loan.
Over the term of the loan, just by
offset
so
account.
having all of your savings in there, and I can give further examples if anyone wants to ask them later on. But
no, that makes sense.
That's not even on. That's just on that's paying 3% interest, so it's conservatively.
Yeah, right. Okay.
Got a lower interest rate than you're saving even more.
Yeah.
Yeah.
Crazy numbers.
Yeah, no, it's just crazy. And then to be basically straightforward. So increasing your repayments is another one. So if you're paying, say I'll just use 500,000 again just to make it easier. But a $500,000 mortgage at 3% over 30 years, your minimum repayment on that would be $486 a week, which is not much these days.
Yeah.
If you just said, okay, I want to pay an extra $200 a week. Paying weekly and fortnightly is the best thing you can do rather than paying monthly. An extra 200 will take your repayments to 686. You'd save 11 years or just under 12 years off your loan and 109,000 interest.
From $200.
Just from extra $200 a week.
Was it?
$200 a week.
Yeah. Perfect.
Yeah. Sorry, can you hear me still?
Yep. I can hear you. Absolutely. Yeah.
And then I just did an example for say $300 on top of a week. So going to 786 a week, which is still in the scheme of things these days, not that much. You'd save 14 years and 39 weeks, so almost 15 years. You'd basically cut your loan in half.
Wow.
And save 135.
So that shows the power of paying more than the minimum repayment.
That's right. Yeah, that's right. Yeah. Because you're paying that majority is paying off the principal. because the interest is always charged the same over that time, and it goes off your balance. So the more you're paying off, it's charged on your balance, not on what you borrowed originally.
Yeah.
I've got a client at the moment who I just refinanced. He is paying. He's probably obviously a little bit more extreme, but he said he wants to pay his loan off as possible. He's paying $1,500 a week.
Yeah.
Calculated it based off his what he borrowed. He'll pay his loan off in 4 years.
Wow.
We did it over a 30-year term.
Crazy.
Basically, we stretch it over the 30-year term just to give you that leeway, just in case.
Security.
Yeah, just in case something happens and you go down to one income, you can drop it back to the minimum repayments over that time. So if someone goes on mat leave, all right, we'll just drop it back to the minimum while this person's on mat leave, and then once they're back to work full time or part time,
so you're saying as well, if you are on maternity leave or you do drop down to one income, you know, don't get too scared about trying to repay it off while that's happening. Focus on family, and then once you switch back to two incomes, then it's time to ramp it up and really start saving that money and crunching the term of the home loan.
That's right.
Perfect.
They're the best things to look at. Another thing you could do is just one more thing. Sorry, if you wanted to keep, say, $20,000 or $15,000 in your offset account, when it gets to a certain point, so when you keep saving, it gets to say 20,000. Say you always want 15,000 in there. Put 5,000 onto the loan, so you can actually start seeing the balance of the loan come down. And your interest. There's always a good feeling when you see the balance going down, as opposed to just having that in the offset.
Absolutely, because it's a mindset thing as well.
It is. That's right. Yeah, you're like, oh wow, I've actually paid off $20,000 off the loan. It feels really nice.
Yeah.
Any questions for me?
No, I was okay with that. I might just jump back though.
Yep.
And just go through a few other things that we touched on when we're talking about that. So I wanted to give it a landscape of where the property market is and the home loan market is. So there is 10 million properties in Australia, and 60% or 6 million of those have a mortgage. And then we see 60% of mortgage holders renegotiate their home loan at least every 5 years. So that's people reviewing their mortgage, checking on their bank, making sure, hey, I'm getting the right interest rate. I've got all the facilities I want. This other fact that I saw in there was 33% of mortgage holders use one bank, where a third of them use two, and a third of them use three or more banks. So that's using different loan facilities, different bank facilities, all that type, different savings accounts, different investment accounts. Again, it gets confusing, but some people like. The other thing is 44% of Australians use a mortgage broker when they're getting a loan, whereas 40% of us are fairly lazy and we just go to the bank we're with, because they've got all our information and we just knock on the door and say, can you give me a loan now? Whereas 15% of people do their own research and go out and find a new banking institution. And then the final one, which is kind of where we want to focus today, which Ross has already touched on, is 10% of people that have a mortgage actually have a debt repayment strategy. So that means 90% of people don't have any strategy at all to repay their mortgage, which is pretty scary. We spoke about the loan to value ratio being the loan amount divided by the property value. So anything under 80%, the banks look favorably on. You get better interest rates, which Ross just discussed. But then again, if you're 80% or over, generally your first home buyers, there's two reasons why we look at an LVR. One is to use equity, which Ross discussed, and the other is lender's mortgage insurance, which is, I hate lender's mortgage insurance. So what it is, describing briefly, your loan amount's 400, your property's worth 500. That would be nice if somewhere in Sydney had property values at 500, and your LVR equals 80%. So if your LVR is above 80% or more, you pay LMI. So what is lender's mortgage insurance? It protects the lender, not you. So if you default and things like that, they've got insurance for themselves. They still come after you.
But they make you pay for it.
They make you pay for it. And at times it can be tens of thousands of dollars as well, depending on the loan amount.
I did one recently, which was 25,000.
25,000. Yeah, that's crazy.
Yeah.
So other fees when buying property and looking at property, there's stamp duty, which is a state government tax when you buy a property. You've got agents commission, which is real estate agents. They put their hand out when they sell your property. Ross and his friends in the mortgage broking industry, they put their hand out for commission, but it is to be noted that it's paid by the bank. So it's not paid directly by you. So regardless of what banking institution they go to, they get paid and rewarded for their work by the bank.
This doesn't get added into the loan, so you're paying it later either.
Yeah, so it's not like we got you 2.5%, but we chuck my fee on and it's 2.8% instead. So the other one is a buyer's agent. So real estate agents work for the seller, a buyer's agent works for the buyer. So if you use a buyer's agent, generally to purchase a property, they charge a fee for service or a percentage of the price of the property. So when I was working at a property firm, they said there's only two things that can stop you buying a property. Your buying power, so your deposit or equity you have in your home, or your borrowing power, which is your income and credit history. So they're the two things that need to stack up for you to be able to purchase a property or move into a bigger house as well. So we spoke about a few strategies from Ross. Did you have anything to add, Ross, or did you want to jump off?
Probably more on that credit history thing.
Yep.
They're doing comprehensive credit reporting now, the majority of lenders. And that's where they can go back to 2 years worth of all of your debts and see your repayment history. And one thing I would say is if you are looking at doing something in the near future, make sure you pay all your debts on time. Because even if there's 1 or 2 late payments on a credit card, for instance, it's going to bring your credit score down, which is going to limit you to which bank you can go to. I've seen that happening a lot lately.
But it's not just credit cards; it's phone bills,
not just credit cards,
utilities.
Utilities aren't on there yet, or phone bills. They are going to be on there soon, I'm pretty sure.
Okay.
But at the moment, it's just so car loans, personal loans, credit cards, and home loans.
Okay.
Well, I can say, yeah, but just you got to be really careful now.
So even if you miss them by a few days or 30 days,
it puts a 1 or a 2 or a 3 on there.
Okay.
And if you have 3s, they're really bad. 1s and 2s you can usually get away with, but it does bring your score down, and the banks are going to question.
Or you've got to go to a lower tier bank with higher interest rates, bigger deposit normally.
Non-conforming banks, that's right.
Yeah, so rather than getting 2%, you could be getting 7 or 8%.
Yeah, I've seen 6.4.
6.4, yeah.
Yeah, because of this very reason.
Yeah.
Bad repayment history. Yeah.
Crazy. So I wanted to piggyback off the back of what Ross has seen recently with some of his clients and just take a step back about what we see. So your mortgage and your home loan is a critical part of your whole financial future. So it makes up a huge lump sum of your debt and your whole strategy. So if we jump back to week 1, where we spoke about our money story, our money mindset, and your financial thermostat. So the money story we see generally in Australia, many people, back in the good old days, many people would spend their lifetime repaying their mortgage. Once their mortgage was repaid, they would retire, and due to the low life expectancy rates back then, they would soon pass away. However, over the last few generations, this has changed a lot. As people are living longer, the debt repayment strategy of repaying the mortgage over your lifetime and then retiring isn't providing that security and lifestyle that many are accustomed to. So that's really what we're looking at. So most people, as I said, only 10% of people have a repayment strategy, which means 90% of people pay the minimum for 25 or 30-year loan terms. Ross mentioned about the offset account, how efficient that is, whether you're putting your salary into the bank account, which is then offsetting the interest that is accumulating on your debt. I've seen this one work really well. So clients that they don't really know, they need to set themselves a goal. So they fix, it might be 80 or 90% of their loan in, and over the next 2 years, they have a 10 or 20% variable part of their loan. So this portion, the 10 or 20%, they're looking to repay in the next 2 years. So they're giving themselves a goal, something to achieve rather than, oh my God, I've got a $700,000 mortgage. How am I possibly going to repay that? So they break their big goal down into a little goal saying, well, it's only 50,000. Can I do 50,000 over the next 2 years, 25,000 a year? Probably yes, no, depending your situation. And that's really what we've seen work well. Ross mentioned doubling up on payments, moving from monthly repayments to fortnightly or weekly repayments are even better, because you're paying more frequently, which means there's less interest getting charged, which ultimately means you're paying down your debt quicker. I've seen work really well. We gave an example, I think last week, of someone using their superannuation. They were self-employed though. And again, you've got to be conscious of your age. So it's not for everyone, super, but it can work because of the tax advantages. And then lastly, what Ross mentioned at the start, talking about pulling equity out and really debt recycling. So we look at buying an investment property or a portfolio of shares or other investments. That's something that really supercharges your repayment strategy. So I wanted to dive into that a little bit more. So debt recycling is a strategy that aims to pay off your non-deductible debt, which is your home loan, as quickly as possible, while also building up your wealth in tax-effective manner. It involves replacing or recycling the debt. However, I know people that have taken equity out of their investment property to buy a car, and they think this is tax deductible because it's debt against the investment property, which it's absolutely not. So what determines whether debt is deductible is not what the debt is attached to. It's really what it's used for. Okay, so that's important to know as well. So this is a cool little diagram which I've put together, which tried to explain a little bit what debt recycling is. So at the moment, what's happening is we've got a home loan sitting here. This is all equity in the house, okay? So we've taken a portion of this equity out, which has resulted in a loan, and we've bought an investment portfolio, or it can work for an investment property as well. So what happens then? You get rental income and dividends, which come down, which help us repay the home loan quicker than you would normally. On top of that, because we've got deductible debt, which means you're paying less tax, so we get tax savings, which also help repay the home loan as well. So difficult topic to try and articulate over a webinar in 30 seconds or less. But yeah, I just wanted to touch on exactly what debt recycling is, because you would have heard people talk about it, or I'm buying an investment property, I'm pulling equity out of my home. This is exactly what they're talking about. So it's understanding your LVR, which Ross mentioned at the start, and then understanding what you can and you can't borrow. So this just explains what I just went through as well. So what are the risks? There are risks involved because debt recycling is considered high risk strategy because you're borrowing money to invest and you're using your home to secure. So during the global financial crisis, we saw lots of people get stuck when the share market crashed and when the property market stopped as well. So interest rates as well can affect this strategy, and it also puts your family home at risk. So borrowing money to invest can lead to bigger gains when the markets are rising, but it can also lead to bigger falls when the market's falling. So if your interest rate on your loan isn't fixed, you can get affected by rises in interest rates as well, which can lead to higher repayments, which can put pressure on your personal cash flow. So there's all these different types of risk you need to consider before jumping into the right debt repayment strategy for you. Was there any questions around that? Ross, did you have anything to add?
No, that's pretty good. I think one thing I would add is when you're looking at pulling equity out of your property, generally we only take it to 80%. You know about that.
Yep.
You're not going to go and pay lender's mortgage insurance if you don't need to. So we'll just look at what's your LVR now. So for 60%, generally the rule is you look at up to 80, so you've got 20% equity. That's when they come and talk to you.
Yeah, perfect. Another question, Ross, probably out of left field, but staying with lender's mortgage insurance. If you've already paid lender, say you're a first home buyer, you only had a 10% deposit, so you've paid lender's mortgage insurance.
Yep.
But over the last 3 years, because property prices have gone nuts, you've got equity in your house now.
Yep.
Can you borrow up to that 90% again, or do you have to pay lender's mortgage insurance?
If you stay with the same, they'll give you basically like a refund sort of thing. You come in down, so that they take that into account. If you change lender, then you've got to pay lender's mortgage.
Okay.
And it depends. It depends on the lender as to how much equity they're willing to pull out.
Right.
It's a bit of a hard one to do because all the banks are very different when it comes to that.
Yeah, they don't make it simple.
No. They've all got their own policy. So it's just up to us to do the research and work out what's going to be the best for that person.
Perfect. So probably the key message to take out of this is review and track your home loan and make sure you've got a personalized debt repayment strategy. But not one that works for your parents, your friend, your brother, your sister, one that works for you and your family situation. As Ross discussed, there's maternity leave, kids come in, you drop to one income. So plans change, things get altered. So that all needs to come into effect and really form your debt repayment strategy. Next steps, homework, review what we've gone through. I'll put some questions up on the website as well to help narrow your focus when you're looking at your own personalized debt strategy and setting your own personal goals. If you have any additional questions, please reach out to myself or Ross. I've got Ross's details there as well. And we look forward to seeing you next week when we start to build and get more exciting and we discuss all things investment as well. So today was just about home loans, looking at repaying it. And then next week, we talk about building your wealth on top of that. So thanks for your time today, Ross.
Thanks for having me.
And look forward to catching up soon. Thanks, guys.
Thanks, Maddie.